Thank you, everyone. This is Jeremy with Flyer. Today, we are joined by Chris Loffer from Caliber. Chris started Caliber after the 2008 market crash by flipping homes in Scottsdale, Arizona. As CEO, Chris directs and executes global strategy, oversees investments and fund management, and contributes to private and public capital formation. Chris, thank you for joining us today. I'm going to hand it over to you now.
Thank you, Jeremy, and welcome everyone. Looking forward to going through the presentation. And my intent today, we've got about an hour together, is to get you as much information as I can on the current state of opportunity zone investing in the country. Certainly our fund, our strategy, and our view on the world as well. But to leave as much time for questions. We've got well over 200 attendees on the call, and to the extent that we can get a really dynamic conversation going on about opportunity zone funds, opportunity zone investing, Caliber, et cetera, I think that's going to make probably create the most value for everybody on the call, as your questions probably are the most relevant things we need to talk about anyway. So I will go through a structured discussion on Caliber as a sponsor of multiple real estate investment funds, just so you have an idea of who we are, what we do, and why it's interesting. And then I'll go through a little bit on our fund, our strategy, and our take on the world. In the middle of that, I will likely, take you through my view on the industry and how things have evolved, where we stand today, and hopefully, like I said, leave plenty of time for us to talk, discuss, and such. I love typically to be interrupted to take questions live at the moment. But in order to kind of get us all the information out, I'm going to just go spin through the presentation first. Please put your questions in the Q&A in the chat, wherever you're supposed to put them, and we'll go through them systematically once we're done. So Caliber, as a sponsor of real estate investment funds, essentially an alternative asset manager in the world of financial services companies, is out there every day looking to create and build interesting investment products that give investors, high net worth investors, ultra high net worth investors, registered investment advisors, broker dealers, small institutions, family offices, access to middle market real estate investments in middle market size funds. What's a middle market fund? Typically $100 to $500 million offering. A middle market real estate investment is typically $5 to $50 million in size. And it's kind of a special place in the world of real estate investing because it allows us to enter into deals and opportunities that have what I believe to be the best possible outcome of less competition while still being a great quality institutional asset. The company has about $500 million in assets under management today, and another $1.5 billion in assets under development, which is land that we own, that we are in the process of developing. And as we fully build out that land, we'll grow the company's AUM. Our expectations over the next couple of years up until 2025 are to grow our AUM to about $4 billion in size. And we're a regional focused company. We focus on what we call the greater Southwest growth markets, which includes Arizona, Colorado, Texas, Nevada, Utah, Idaho. Frankly, places that were really great to invest prior to the pandemic and have since become even better to invest in because the growth of population and jobs in these markets has really exploded. Just to, kind of get us started here, I'm going to jump into what I would say is the what's in it for me concept of opportunity zone investing. I'm sure many of you on the call are intimately familiar with the tax structure, the strategy, the nuances of the law. But to take a zoomed out approach, let's look at, what is a, traditional investment in a non-opportunity zone structure making 8% a year in annual growth over 10 years look like as compared to an opportunity zone investment in an opportunity zone fund with the exact same rate of growth. And so when you boil it down, you start with $1 million and you pay one round of taxes in the opportunity zone investment versus 2 rounds of taxes in a traditional investment. At the end of a 10-year period, you have about $1.3 million net of all taxes in a traditional investment. So you're making a little over 5% a year based on your $720,000 starting point, or a little less than 3% a year based on your $1 million starting point. And in an opportunity zone investment, you're making 3 times that, essentially $900,000 in net profit from the investment, again, earning the exact same rate of return. So the what's in it for me is, if you're going to lock up your capital for 10 years and you're going to earn the theoretical exact same rate of return on an investment, you're going to get a much better profit outcome after tax because of the benefits of the tax incentive. And about 80% of that outcome is driven by the ability to avoid future taxes on the value growth of the investment, which means as long as you invest for that 10-year period, you hold your investment through the 10-year cycle, about 80% of the tax incentive value is driven by that particular feature of opportunity zone investing. So for those of you who said, well, I wish I would have gotten it in 2018, it's 2021, the program is kind of slowly sunsetting parts of it, you're not missing out on much, because as long as you make an investment today and hold it for that 10-year period, you're getting most of the benefit, mathematically speaking, of course. And then, of course, the program runs through 12/31/2026. So for those of you who are in the financial advisory community and are helping investors try to bring this into their strategy of selling their business and then putting some of their money into real estate, you've got quite a window. It's a great time to invest now, but it's going to be a great time to invest next year, the year after that, as long as you can afford the 10-year hold. Top level, how do you maximize this incentive? There's really 4 things, in my opinion, you've got to do. One, and first and foremost, is you have to grow the value of the capital. If you don't take $1 million and turn it into 2 over a 10-year period and have some real value growth in the value of the capital, you're not driving much of a tax incentive, because the big incentive is not having to pay taxes on that future growth. 2, in my humble opinion, I think diversification is key. Early days of opportunity zone investing, a lot of people were being advised, invest on one project, hold it for 10 years, and hopefully it goes well. In real estate investing, just like any form of investing, we don't know how the market's going to change. We don't know if 10 years from now people aren't going to be using cars. We don't know if people are going to be obsessed with energy efficient homes, and therefore they're not going to want these old school apartment deals. So you've just got to really, I think, diversify across different markets, different asset classes, and shoot for making a few bets instead of a single bet. I think it's very important to look for strategies that allow you to compound your gains over a 10-year period. In real estate development, typically, if you're going to buy something, develop an asset, construct it, get it leased up, you're looking at about a 5-year window. And in that 5-year window, most of us underwrite to a 2x or better equity multiple, meaning we're trying to double the value of the equity within that first 5 years. After that first 5 years, you're just holding it and hoping the market appreciates at that point in time. So the majority of the upside is in the value creation of building it and leasing it up in the first place. And if you can do that twice within a 10-year period or more often, you can compound those gains, you can redeploy those compounded gains, and you can produce the best possible outcome for an investor. The program does allow us to sell an asset within a fund and reinvest within 12 months and maintain the tax benefit within the program. You could produce some interim taxable capital gains, which of course can be handled with interim distributions. And then the last, but certainly not least, is I think in order to maximize the tax incentive side of this, not just thinking about the real estate side, but the tax incentive, if you can maximize the exit, of course, sell for the highest possible price, you're going to get the best tax incentive. And that could come from selling assets individually. It could come from a portfolio sale, or it could come from rolling up a private portfolio into a public REIT and giving the investors access to the spread between private valuations and public valuations, and the ability for an investor to decide when they're going to sell their shares in the portfolio versus making that decision for them as a fund manager. I mentioned middle market real estate as a hidden opportunity, in the world of investing. The reason why is pretty simple. Anything less than $5 million in project size and real estate investment has a lot of bidders typically. a lot of small real estate investors, entrepreneurs, part-time investors can invest in a project of that size. They're typically fairly simple to execute on, and therefore you're constantly fighting the market. On the other side of the equation, as we all probably know, there's been a massive rush of capital looking for income to try to fund kind of the baby boomers retirement generation. And in doing so, institutional large real estate portfolios that produce consistent income have become, almost a bond replacement. And so institutional investors, real estate funds, et cetera, are sitting on tremendous amounts of capital, constantly looking for investments in projects. It's a very bid up market, and anything over $100 million in project size typically is going to be bought by an institution. Therefore, again, a very efficient market, and not great for us to find inefficiencies in value add opportunities, buying below market, those types of things. In the middle market, typically $20, $30 million deals, you're buying assets that are as complicated as those institutional assets, and so therefore hard for the entrepreneurs to execute on, but not big enough on their own on a project by project basis to be a target for an institution. So a middle market investor like us would come in, buy and build lots of $20, $30 million deals, build a portfolio, and sell it into the institutional market. Really great opportunity that creates a U-curve in terms of competition for those assets. And bottom line, if you buy at or below market, kind of price, you have a better upside on your sale. Like I mentioned, Caliber is regionally focused as a sponsor, and that is essentially designed to follow long-term trends of population growth, long-term trends of job growth, and regulatory environments that at least embrace or encourage development. Doing so has actually turned out to be a huge boom for us, because the trends that have been accelerated since March of 2020 have now created even more rush into our markets and a desire for supply that doesn't quite exist. As an investment company, Caliber is essentially structured to provide various forms of private offerings and funds to investors. When someone walks in the door at Caliber, we try to understand what their needs are. Are they looking for tax advantages? Are they looking for growth? Are they looking for income? And then fit them within those needs into different funds and sometimes syndicated offerings of specific projects. So our investors and our clients come in as limited partners here. They invest in the funds, which are typically structured as LPs structures, and then Caliber acts as the general partner, which provides investment management to the funds. We get a profit sharing interest in the deals. And then we also provide services, which include construction management, development management, asset management, brokerage, basically the entire cycle. The funds themselves own the real estate and related holding companies. So the investors are a direct owner in the real estate through the funds, and they rely on us as their manager for hire. From a track record perspective, the company has done exceedingly well in the last 13 years in terms of produced track record. We haven't sold as many properties as we'd like at this point in time, because we had a lot of sales we were expecting to do in 2020 and 2021. But such is the way of the world. Sometimes markets change. Of the sales we've had, we've realized a 2.1 net equity multiple over roughly a 5-year period. So if an investor put in 100,000, they got 210,000 back in cash, which includes the return of their capital, their profit, and any rents they earned along the way. And in terms of the history of us in the world of opportunity zones, we were one of the first opportunity zone funds to open in the country. We were able to do that because we had excellent guidance from some of the best minds in the country around the program. We've hosted members of the White House. We were a contributor to opportunityzones.gov in terms of initial projects. We've been featured all over the place. And the reason why we do this is to promote the industry and hopefully convince lawmakers to continue the program well into the future. But we also do it because the more that we promote our status in the industry, the more likely we are to get those off-market opportunities to invest in a great opportunity zone project. A couple of case studies for us in the opportunity zone space. This is a real estate investment, pre-traditional. The deal came to us from the CFO of a large healthcare REIT who had a non-conforming deal. It was a $23 million deal. Didn't fit the REIT's typical $100+ million box. And he got permission from his board to take it outside the REIT and develop it himself. He brought it to Caliber. Caliber acquired this asset, which was a boarded up assisted living facility. We gutted it, renovated it, and turned it into a state-of-the-art acute care behavioral health hospital, signed a 20-year lease with a credit tenant, and the property is now up and running in our fund. It is producing about a 10.5 cap on cost, about 15% levered cash flow, and we're into it for about $23 million. It's worth around 35 today. So great deal for us. Great example of what you can do with an opportunity zone investment to take a boarded up building that wasn't used and solve a critical need, more behavioral health services, beds to service that need. And then of course the job creation and then the value creation in the investment and what it's doing for our clients. Another example of what we're doing in the opportunity zone space, this is more on the business side. As an investor in real estate, that is our focus, but because we have 10-year capital, because it's more flexible and it's not looking to invest in one specific strategy, we're able to buy, in this case, we bought a historic kind of downtown area in the third largest city in Arizona. And as part of that, we're providing above market lease incentives to bring in great brands. And we invested in those, essentially in those small businesses. And in exchange for that lease, we're getting a rev share on their top line. So we're able to stand up their company, build out their space, and then bring in a lease that will be an above market lease, assuming that they perform on their business plan. Our clients kind of are the heartbeat of Caliber. We've got over 1,200 active accredited investors. We've raised over $500 million in equity since inception, over 13 years. And we'd love for you to join the Caliber community. That community includes, like I said, direct investors through our private client group, which is kind of high net worth, ultra high net worth investors, as well as a B2B relationship on the institutional side with investment advisors, broker dealers, family offices, and small institutions. So taking you out of the realm of the sponsor entity of Caliber, which also does lots of other things, and bringing you very specifically into our Opportunity Zone Fund. This fund is open, active, and taking capital. And I just want to take you through the strategy of the fund, our thinking around opportunity zones, what we've done so far, and that I think will set up a really good conversation going forward. First and foremost, I think as an investment, either an investor or an investment manager, you've got to say, regardless of the tax incentive, why would I take money from the sale of a business, the sale of stocks, the sale of another piece of real estate, or some other form of capital gain, and invest it into a fund that is essentially a real estate fund at this time? Isn't real estate, at a pricing high? Is it a good time? That's fundamentally the first question, right? Jim Barry's quote here from BlackRock, he's the chief investment officer for alternatives for BlackRock, basically is saying to you that the best buying opportunity in modern history for private assets and alternative assets was the 2008 financial crisis. Since then, this current disruption that we're seeing in the market from COVID is creating the second best buying opportunity in modern history since that period of time. So I think that is a compelling macro look at why you would want to take a win from the stock market or a win from selling a business and push it into private assets, period. Now that could be real estate, that could be private lending, that could be venture, that could be private equity. In our world, it's real estate investing. But to get a tax incentive to do that, I think is a sound strategy. As many of you probably already know, alternative investments and alternative funds are becoming mainstream. We're at over probably 11 trillion now in alts in the market. Preqin predicts that we're going to go to 17 trillion by 2025. And you can't do that entirely with institutional funds and institutional assets. There just aren't that many out there. You've got to enter the middle market, just like you have small and mid-cap stocks. You need to have small and mid-cap alternative asset strategies and funds. From our perspective, I think there's three things that really matter in terms of what makes a great opportunity zone fund successful. One is, in this form of real estate investing, you do have to have significantly better fund infrastructure than you would for a typical private real estate development fund. So yes, what we're doing is raising capital into a fund, we're buying development sites, we're building buildings, or we're doing adaptive reuse, heavy lifting renovations. That is a fairly simple process, although it takes a lot of execution. And typically you put the money into a fund, you do fund reporting, and you send out a K-1, and you're kind of done with that side of the equation. In an opportunity zone fund, you've got to report to the IRS twice a year. You've got to manage all of your cash positions and ratios. You've got to manage cash at the fund level. You've got to manage cash at the QOZB level, which is the next level down. And you've got to make sure that the assets that you're buying are compliant with the rules. They're actually physically located in an opportunity zone, and that the written plan you have for each deal would comply not only with the actual written law, but I also would believe with the spirit of the law. And so to do all of that, you've just got to have a little bit more sophisticated infrastructure. And at Caliber, we have in-house accounting, financial reporting, tax, investor reporting. We've got internal people who are managing this. And then we work with best-in-class partners like Deloitte, who's our auditor, Snell and Wilmer, and Novogradac, and several other folks in the world of opportunity zone investing. So I think it's very, very important to have good infrastructure. Last but not least, it is pretty clear there's over 17 bills on the horizon to reform opportunity zones, and most of those bills include additional reporting requirements. I think as a fund, you need to be producing an impact investment report and be prepared for those reporting requirements. Caliber just issued our first impact investment report, and we will continue to issue those reports to our investors as well as to the public over time. Two, on the track record side, you've got to have a track record of execution, because as you raise capital in these funds, you've got to deploy it within 6 months typically. And that means you've got to have a kind of a constant source of deal flow to match investor capital to incoming deals. Otherwise, you're putting yourself as a fund manager in a position where you're feeling pressure to deploy capital, and you may be taking risks that you wouldn't want to take if you don't have that deal flow. Most every deal that we've ever done at Caliber has been off market, has been brought to us directly, and is typically brought to us because of our reputation and our capability to execute, which I think is a very important component to the structure. And last is that execution piece. This is a program that requires you to get built within 31 months. There's exceptions to that, but it's still a relatively aggressive timeline for new construction. You've got to be able to work your way through entitlement processes, zoning. You got to work your way through, politics, city councils, you name it. So there's a lot of execution involved in taking a dollar into an opportunity zone fund and turning it into hopefully $2 or more on the other side. And having a track record to execute is important. I want to talk you through a little bit around the strategy of the fund. We are targeting a 13% IRR net to investors, a 2.5 equity multiple. That target is reasonable based on the fact that we are doing opportunistic real estate investment, which historically speaking makes around 12% a year unlevered, 20% a year levered. And while the targets are a little bit nerfed because we're using 50% debt, and we in our original model assumed that we were holding assets for 10 years, now that we can actually turn assets within the 10-year period, we should be able to continue to enhance that return. The window to invest is essentially all the way through 2026, although this fund will likely close either this year or next year. And then the fund will be out there deploying capital. We expect to start the process of the wind down into 2030, whereas we won't fully wind down the fund until past, at this point in time, 2031, because you need at least 10 years in the fund to get your full tax benefit. And our wind down, most likely our exit strategy will be a uplisting into a REIT, taking your shares public At that point in time, you'll own public shares of an income producing portfolio of real estate, which puts you in the position to sell your shares when you're ready. So to the extent that you want to hold your units for 15 years or 20 years, you can avoid paying capital gains taxes on the growth for that entire period of time. Just want to go through some of the assets we have within the fund to give you a couple stories of the deal so you can kind of see where we're at. As an investor in our fund, you would own a proportionate share of these assets as well as every deal we buy in the future. This is a property that's connected to the convention center in downtown Tucson. It is fully constructed now. We got the land for $1,000 a year, and we have a requirement to buy it in 50 years for its then current market value, or the market value today. So we get to pay roughly $2.5 million 50 years from now to buy this land. And then we got a deal with the city to get about $6 or $7 million in equity incentives. So we're into this hotel, new construction, for its construction costs, essentially less the value of the land and essentially less the equity incentives from the tax side. So we're into it for sort of a negative construction cost number. And we did this deal because it's a fantastic project. And the fact that it was completed and opened in kind of April of 2021 means that we missed the majority of the pain and suffering that came from COVID. Asset number 2 here, this is a townhome project we acquired in 2018. We're essentially building 39 units, new construction townhomes. We've got phase 1 is built and occupied. Phase 2 and 3 will be fully open in 2022. And we condo map this. So we built these as energy efficient townhomes. Every townhome can be sold off individually. We're running it as an apartment complex to get the best possible financing right now and to capture the upside in the market. And then at the end of the 10-year mark, we intend to refresh the renovation on these and sell them off as condos, which we think will give us the best possible exit. I already mentioned to you the behavioral health hospital, so I'm going to kind of whiz past this one. And then the downtown Mesa portfolio is roughly 10 buildings that we've acquired over several years. That gives us about 30% of downtown Mesa. This is buying a bunch of buildings at about $80 a square foot in purchase price. That's about less than half of what it would cost to build these buildings, that are all kind of contiguous and part of a historic downtown that's being transformed, alongside a new campus for Arizona State University that's opening in downtown Mesa and driving a lot of growth and change. And then the Rancho Solano schools deal, this is a property that we expect to start construction on in the fourth quarter. It was essentially an extension to an existing school. Again, we've got a 20-year lease with multiple buyout options from an existing school tenant. And that's just kind of where we're starting. We have, in addition to that, over $500 million of mixed-use development in what I think is one of the best census tracts in the country for opportunity zones, including, the office and R&D facilities that we would be doing. It's a smart city-oriented development as well. It's got some entertainment components, some residential components. We've got a wellness campus, which is essentially all medical in that same census tract that we're investing in, starting with a medical office building, including also assisted living and independent living. We've got ground up apartments we're doing in downtown Mesa with a HUD takeout. So as an investor, you've got pretty good visibility not only into what you're going to own, but also what we're buying next. And we're happy to, once you become an investor, disclose some of the confidential details of those projects. Of course, last but not least, we've got our impact report that we recently issued through NES and JTC. And that is available to anybody who would like to review it. It's part of the marketing package for the fund. On the structure of the fund, very quickly, so we can get into the Q&A, we have a maximum offering on this fund of $500 million. I think we'll probably cap out at around 2 to 250 and close the fund and then open fund 2, just to make sure it doesn't get unwieldy in terms of its length. It's a expected hold period of 10 years from close. Management fee is 1.5% of the invested capital. It does not grow with AUM growth, and it doesn't grow with, your fee won't grow over time, essentially. We've got a 6% pref with a catch up. 75-25 split for a $250,000 minimum investment, 80-20 split for $1 million minimum. And for those of you who are investment advisors, assuming that you're going to bring us the full $1 million from your client base, we give all of your clients access to that better profit split, which I think is a value add for those investment advisors to allocate to Caliber. Like I said, the fund's audited by Deloitte. Our attorney is Snell and Wilmer. Tax counsel is Mark Schultz, who's pretty well known in the opportunity zone space. We have a tremendous team behind the fund. And then an important note that's not on this slide is that the company Caliber is designed to provide services to the fund so that we can kind of maximize the benefit of control over the actual results of the real estate investments while still maximizing the benefit of using third parties. And so the way that we do that is that we provide construction management services from our own licensed general contractor. So we have boots in the ground on every construction site, but we're hiring third-party GCs to do the construction because they have scale, they have maybe a specialty in that specific type of construction. And we get kind of the best of both worlds. Same thing on the property management side. We hire third-party property managers, best in class for that asset class in that location. But our internal asset managers on staff oversee the third-party property manager to ensure that they are held accountable. In doing so, we earn income as a service company that is at or below the market rate for those services, but we don't charge fund level fees within our fund. And we raise most of our capital directly. So the majority of your cash that you invest in our fund will go into the real estate. You won't have nearly as high level of initial loss of your investment as you do through the traditional kind of non-traded REIT or broker dealer channel. And then in addition to that, because if we don't charge like an acquisition, disposition, construction fee, et cetera, at the fund level, whatever the cost of those services is all you pay. That extra layer of fees being cut out also enhances your return. So as an investor coming direct to us, that is a huge benefit. Just want to close, we work with some of the best people. We're positioned, I think, in some of the best markets. We've got a team that is deeply ingrained in every deal and knows exactly what we're doing. We're not just asset allocators or capital allocators. And we've got distinct strategies around investing that work together and support each other along the way. So I'll leave this up here for a moment while we start to go through some Q&A, and then I'll just turn this off so we can get kind of our photos up, and we'll go from there. That's my personal email that does go direct to me. You can also email the company at invest@caliberco.com if you want to go to the general box, which will be taken care of by the team. And I invite anyone who is in Arizona that wants to come see us in Scottsdale. We typically will host tours. We'll have you, spend part of the day with us, go look at some projects, and come meet us. Come join become another family within the 1,200 or so investors that we've built so far, and help us continue to grow this business. So, thank you very much, and let's go through the questions. We got a ton here.
So yeah, Chris, you have a bunch. Just want to give kind of some housekeeping. If you have questions, if you could put them in the Q&A box, it makes it just a little bit more manageable than put them in the chat. I'm going to hand it over to Victoria so she can go ahead and ask everybody. And if you guys don't get to the questions during the webcast, they will be passed on to Chris. So feel free to put your questions in the Q&A box. All right, Victoria, you want to go ahead?
Yes, thanks, Jeremy. Chris, first question. I currently have a new construction triplex for sale in an op zone in Los Angeles. My understanding is that we can sell it pre-certificate of occupancy. Is that correct? And do you have any feedback on how to attract buyers who may see this as risky?
Yeah, that is a hotly discussed topic in the world of opportunity zone investing. I have met many very smart people who say that that's correct. I personally don't feel super confident with that strategy because the IRS can do things called, anti-abuse regulations. And if they see that as abusive in some way, shape, or form, they might restrict us from being able to do that in the future. But to my knowledge, there's not a restriction on it now. I am not an attorney. I would highly recommend you talk to an opportunity zone attorney. Mark Schultz is a great competent one you could reach out to, and I'm happy to connect you to him if you email me. But that has been discussed. We have looked at that particular strategy as an investor to invest in projects. But because we haven't actually pulled the trigger or gotten close to pulling the trigger on something like that yet, I haven't gone deep enough on the question to give you a confident answer.
Awesome. Next question. What would be the impact on returns if there is a change in tax laws that raise the tax rate that are in effect in 10 years?
Yeah, so we got to do a little math. The current tax rates are around, let's call it 25 to 28%, depending on what state you live in, assuming long-term capital gains. The Biden administration, proposed 40%. Everybody kind of, I think in my world, thinks that that's going to level down to around 30%, maybe 35%. But if they were to raise the tax rates, then you would pay that higher rate in 2027 when your tax bill was due in April. So that's a downside. The upside to that is 3 years later, you would avoid paying that same rate, higher rate on the upside of your investment. And because you got to invest the full $1 million in my example versus 720 in the first place, and you get to defer paying the taxes, we get to earn you a rate of return over that period of time. And because you get the step up in basis this year of 10%, so you're going to pay taxes on 900,000 instead of $1 million. Even at the higher rate, even considering all those outcomes, if you run it through a model at a reasonable growth rate, the impact of a higher tax rate 6 years from now is negligible. So when you actually do the math, it's not much. And because of the additional benefits you're getting by investing essentially the government's money for that period of time and earning a rate of return on it and avoiding that future tax bill at that higher rate on your gains.
Is there any referral fee to licensed professionals who refer 10 million plus of accredited investor client commitments?
Yeah, as long as you're licensed, all of our funds have a managing broker dealer structure, and we're able to sign a selling agreement and various forms of referral agreements. We do work with folks in the licensed community. We do disclose within the fund that we can pay commissions, and we typically are, even with that structure, we're typically paying significantly, or we're typically absorbing significantly less cost because the company raises a lot of money directly. So to the extent we do pay a commission to a referral party that's appropriate for the market, it blends down into a cost level against the rest of the capital that is much more acceptable compared to our friends in the non-traded REIT industry.
Are your financials audited?
Yeah, so our financials are audited annually. Deloitte is the auditor for Caliber Corporate as well as all of our funds. And so Deloitte issues the opinion, and Caliber's corporate financials are actually publicly available because we're a public reporting company. So we've got, I think, significantly more infrastructure compared to most small real estate developers that are doing opportunity zone funds. There's about 1,000 opportunity zone funds in the country. Probably 600 to 700 of them are sub, $25 million offerings, doing one-off deals one at a time. And a large portion of all of the funds are actually run by, people who traditionally came out of the tax credit industry. So they were doing low-income housing tax credits, historic tax credits, et cetera. Great programs. Those development shops make money and do well for their investors, and they provide a really valuable service in affordable housing. But it's an entirely different business model from the concept of buying something for X and selling it for 2 to 3X. In most cases, in an affordable housing deal, you're trying to make any amount of money on the real estate that you can, which is usually not much. And the tax credit that you get drives the incentive and drives your rate of return on your investment. In the world of opportunity zone investing, if the real estate doesn't grow in value significantly, you don't have a tax incentive that is meaningful. So it's very important to work with a market rate developer that probably understands that, or an affordable developer that has been able to make that cultural shift.
Is Caliber an RIA?
We are not. We are a sponsor of private real estate funds, and we issue our funds under essentially under the rules regarding sponsors. We're vertically integrated, and so that gives us exemptions to being registered under the SEC. But all of our funds have a managing broker dealer associated with them, so they are sold vis-a-vis FINRA.
How would you expect your fund to perform in the next 3 years if the same 2008 financial crisis happened today? How leveraged is the fund?
So actually, if the 2008 financial crisis happened, we would be unbelievably well positioned to take advantage of it. One reason why is that the first 5 years of our business was doing exactly that. We were buying foreclosure properties, auctions, buying non-performing notes, buying REO properties, doing everything you can do in the world of distressed real estate. And what the distressed market does for you is it lowers your buy price at such a low level that your returns are typically 2 to 3 times what you can get in a non-distressed real estate market. Our fund operates at less than 50% leverage right now. We're at around 38-40% leverage. And we're not using a lot of debt in the fund because we want to make sure that in 2025, when we lever the fund up to a maximum of 50% LTV, as we have a performing portfolio, we can distribute at least 30% of the equity back to our investors in the form of a tax-free distribution, so you can pay your taxes in 2027. So we're using a low amount of leverage, and we're generating the returns by buying right and by building value into the real estate itself, not by trying to play the interest rate arbitrage game.
Sorry, I was muted. Do you include C-PACE in your cap stacks?
Do include C-PACE. What is C-PACE? Are you users of PACE loans? I think that's, PACE capital from the kind of the environmental piece. We haven't done any because we've been doing most of our projects in Arizona and Arizona hasn't quite figured that out yet. But to the extent PACE financing is available, we certainly will include it if it reduces the cost of capital and increases our returns.
Is Caliber back to funding development projects?
Yeah, we are in this very moment in time, David. We have 2 projects heading into contract where we are providing all of the capital for, as I listed on that slide, about $650 million worth of end state development. We're structured those as a co-GP deal where we're coming in. Well, one of them is a co-GP deal, one we're the principal developer on. And on the co-GP side, we have a 30-year healthcare developer who has a site that they've got the infrastructure in and they need to kind of build out the rest of it. They have excellent expertise in the healthcare development side. We have expertise in all the other parts and pieces, and we're a really good partnership. So we are looking for other deals and developments. That kind of ebbs and flows. Probably over the next 2 to 3 months, we'll be focused on closing the projects we already have. And then as we enter into the fourth quarter, we'll be looking to continue to fill the project stack back up again.
Has the prospect of water shortages and other impacts of climate change affected your view of the geographic focus you currently work in?
Yeah, I spent a lot of time on water. As you can imagine, our largest development right now is in Colorado, which has water is a big driver of what you can and can't build in Colorado based on water availability and usage. I think climate change is an important issue. That's why we're building into all of our developments the concept of low water use, energy efficiency, and all the things that are necessary to make sure that we keep our usage down. Most of our developments are in Arizona in the Opportunity Zone Fund. And little known fact of Phoenix is since the 1990s, Phoenix has grown significantly, but we still use the same amount of water today that we used in 1990. And part of that is because of xeriscape, of energy or water efficiency, and essentially good planning. Phoenix has over 100 years worth of water sitting underground in the aquifers, not including our allocation of the Colorado River. And so to make a very long story short, I'm not worried about water in Phoenix, which sounds weird. I know it's a desert, but we've got really good access to water. It is something we focus on all of our projects to make sure we don't put ourselves in a position where access to water could destroy our returns.
Can you speak to current institutional investor appetite when it comes to impact OZ deals, or are you exclusively working with single-family offices and high net worth individuals? Are impact deals structured differently?
Yeah, so institutional investors, the reason why we sized our fund to 500 million was so that an institution could make a $25 to $50 million allocation and own 5 to 10% of the fund, but no more. We anticipated a huge jump of RIA complexes in particular, private banks, wealth management groups, et cetera, to jump right into opportunity zones the moment it happened. And it didn't happen. Part of that was driven by the fact, or the majority of that was driven by the fact that the regulations weren't finalized until December of 2019. And then 3 months later, COVID hit the country. And so we saw them jumping in the Q1 of 2020. And then we saw everybody pull away because making a 10-year bet in the middle of the COVID pandemic last year was just not going to happen. What I'm now seeing is everybody is like, oh God, we got to get into this thing because everybody's looking for that tax haven. We just 2 days ago announced an institutional separately managed account with a bank, co-investing alongside our Opportunity Zone fund into CRA overlay areas as well. I anticipate that to continue to happen throughout the rest of this year and into the next couple of years, assuming that investors see what I see, which is the majority of the value of the program is being able to avoid paying taxes on the future growth. And unfortunately, until they decide to extend the law, we're losing some of those benefits over time if we let the law continue only until 2026.
Can you please discuss the benefits of a 1031 versus opportunity zones?
Okay, yeah, this is fantastic. So a 1031 exchange can be a fantastic way to invest in real estate. Let's take a $10 million project that you sold, and let's say you had 5 million in tax basis and 5 million in capital gain. You've got to roll the full 10. Typically, you're going to buy a $15 million project or more because you have to typically use at least the same amount of debt you were using in the past or more. So you're going to see that project continue to lever up as you get older and older. And you avoid paying all capital gains taxes until the next round when you sell it, and you've got to do it all over again. Got a 45-day period to identify, and then you've got your period to close. The problem with that is the best time to sell an asset, of course, is when the market is high, and that's usually the worst time to buy an asset. And in the 1031 exchange, because people are on the clock, they often overpay for that next asset because they're on the clock. There's a lot of problems in that side of the equation. And if you're an investor, you just sold an asset for 10 million and you walk away with no cash. You're just buying a new income producing asset, hopefully in the future. An opportunity zone is in contrast. If you sell that asset for 10 million and you've got 5 million in tax basis, you can take that 5 million in tax basis and put it into your bank account. You can put it into stocks. You can put it into your business. You can release the cash that's in the tax basis and do something with it. If you invest the full 5 million of capital gain into one or more opportunity zone funds, your investment process is better because all you're doing is selecting funds and allocating capital. The fund manager then has, after you select them, 6 months to go out there, find great deals, and typically they have deal flow already. So they have good quality projects that you're investing into versus you running around the market trying to find a good deal. So that's kind of the big compare and contrast. You do eventually have to pay your taxes on your original capital gain in an opportunity zone fund in April of 2027. But once you do pay those taxes, you're protected from the gain of future value for at least 10 years and up until 2048 if you hold the investment that long. And so you're producing a really big protection on your future gain tax. And when you run the math out, if you expect that you'll ever pay taxes on the position that you've been rolling forward under 1031, assuming you don't want to just die and let the step up in basis take care of it, then you are making out much better to define your window of, okay, I'm going to be illiquid for another 10 years, but then I've got a way to unwind this tax position and get out of this game. So it's a really good way to unwind a 1031. It's a really good way to bail out of a 1031 if you've found a couple of deals and decide you don't ultimately want to buy any of them. As long as you're still within your investment window, you can invest in an opportunity zone fund. and still get a great tax benefit. And I think most importantly, it's in my humble opinion, more likely that you're going to get involved in projects that are going to be good quality money-making projects in an opportunity zone fund than in running around trying to place capital and identify assets within a month and a half.
For Caliber, what is the sweet spot transaction size span here in the US?
Yeah, so we're middle market investor. Average deal is around 20 to 30 million bucks, 25 million probably in the middle. And anything above 50 million, we start competing with institutional investors. As long as we can put in some way to avoid that competition and not have the price of the asset get bid up, then we'll look at larger deals. And we're doing a lot of developments where it might be a $300 million development, but it's $10, $30 million buildings, right? And so that's kind of how we break it out and chunk it out over time.
Curious, are you buying land raw or do you go under contract with an option to buy? If so, how long is the purchase option for?
Yeah, so typically we are getting involved because of the deployment timeline, unless we are exceedingly good at doing the raw land piece, and it's in our backyard and we've got a good handle on city council, we're going to buy a piece of land that some other developer typically, or some other party has gotten it through that initial zoning entitlement and it's close to being construction ready. Maybe they've done preliminary planning, maybe they've done maybe they're all the way through CDs. So anything where we can step in and execute the vertical piece is a great deal for us. Anything where we have to start from scratch and come up with the vision ourselves, it's too long of a period of time typically for us to be able to do it within the Opportunity Zone Fund. We do that outside of the Opportunity Zone Fund in our other funds, but in the Opportunity Zone Fund, we want to be able to meaningfully get to income within 30 months.
Are the leases at market rate? Example, the 20-year lease on the hospital. How much of the IRR is from lease income versus cap appreciation?
Yeah, so that is at, it's actually a 10.5 cap on cost at a market rate lease. So we just got a great deal on the piece in itself. It is a market rate lease with escalators, so it will grow over time. And you can do that. So naturally, because the lease is such a good rate based on our costs, and because, you know, even though we're using limited leverage, we're still getting a really good rate of return from the income side. That one's going to produce probably, you know, 15% a year gross income to the fund for the next decade while we hold it. And that's going to be significant. That does not include the appreciation and value. We've put into that deal roughly 7 million or so in equity. And it was reappraised recently for 34 million. We're into it for 23. So you can kind of do the math. We've more than doubled the value of our equity if we sell. And that is assuming that we sell at that price today, which we think will sell at a better price down the road. So the majority of the IRR in our projects is typically driven by that value growth of the equity that we do. And the minority is driven by cash flow. On that particular deal, the cash flow is really good as well.
What is your view of residential projects that include affordable housing? Are any of your projects this type?
I am 100% in favor of residential projects that include affordable housing, so long as we can still hit our minimum return requirement. And allocating a piece of the project to an affordable or workforce program makes a ton of sense to me. It also really helps in these communities that are transitioning, where you've got growth in the community, but you also have a population that needs to be housed at the same time that may not be able to pay those rents. So I think blending it into the project is good. I think being all affordable makes the project a little bit more challenging. But we've looked at projects where we designate a piece of it into affordable, and perfectly happy to look at those deals.
Are there any additional reporting requirements for your LPs?
For the LP, it's very easy. You get a K1. The K1 typically comes to you before the first tax deadline, and you file it, and that's it. when you make the investment, you have to file a form, which I don't remember which the form is, and your CPA should know, that basically just says, I invested X amount of dollars into an opportunity zone fund, and here's the name of the fund. And you'll have to file that every year with your taxes so that the IRS knows not to try to go collect those capital gains. That's it. There's nothing else for you to do. This is not a investor intensive program where you have to spend a lot of time doing that. Now, if you decide, hey, I have a $10 million capital gain and I want to start my own fund, then you can put that money into your own opportunity zone fund. And then you have to do all the reporting that I have to do, which is fairly significant. There's benefits to that because then you can pick and choose which projects you want to invest in. And our fund is structured so that we can bring in co-investment from family funds into the project level. But the downside to that is that as a fiduciary to our fund, if a project meets our fund's requirements and we have enough capital in the fund to put into the project, the fund gets the project. We don't bring in sidecar investing or outside investors in the project unless the fund doesn't have enough equity to fully fund it on its own. So you're kind of second in line, regardless of what people will tell you. If they run their own fund, they're going to have to feed that fund first in order to meet their duty as a fiduciary. So we've only got a couple minutes left. I just want to spin through timelines because that's highly relevant right now. And then if we have more questions, Victoria, we can keep cranking. And if you didn't get your question answered, you can just email me or email us at invest@caliberco.com. I will stick that in the chat here right now. So timelines are really important. It is September 9th. Tomorrow is September 10th. Tomorrow is the last day you can invest capital gains associated with a K1, essentially with a sale of a pass-through interest like a partnership from 2020. So if you have a client or you yourself have capital gains that came to you off of K1 in 2020, you can still invest those gains, frankly, as of tomorrow, unless your partnership had invested on a different timeline, and there's technicalities that we can go through with you if we get on the phone. So I know that's a really fast decision, but I have to make you aware that tomorrow is an important date. The great thing about Caliber's funds is we do take in capital on a daily basis, so you don't have to wait to an investment window, so we can try to match the timeline of your investment with deployment. Item 2 is that's important from a timeline perspective is our fund, unlike other funds, does revalue. We revalued once in March of this year. We're revaluing again as of September 30th of this year. So if you invest prior to September 30th, you're coming in at the current unit price of $1.15 a unit, which is 15% up the cost off the cost basis of the fund. If you come in after September 30th, you're coming in at a new unit price. I don't know what the final unit price is going to be yet. We will be able to disclose it soon once we've got the final valuation done, but I know it's going to be more than $1.15 a unit. So that's important for you to know. And then as far as timelines go, if you have a capital gain, like I said, that comes from the sale of a pass-through interest that comes typically off of K1, then you typically have 180 days from the day of the sale or from the end of the year, 12/31/2020 or 2021 in this case, or you have 180 days from the filing deadline of that tax return, which would be roughly March 15th of 2022 if you had a 2021 capital gain. So you have those 3 different dates to pick from. And if you pick the date as a partner, the other partners are subject to that date, which is why we're on the last possible date for 2020 gains as of tomorrow, because that's 180 days from March 15th of 2021. Item 2 is if you have capital gains from non-pass-through interest, like you're trading stocks, you're selling a concentrated stock position as an employee or something like that, you have 180 days from the day the sale is realized. So if you're a trader and you've got a lot of short-term capital gains from trading, you can invest the gross gains from trading as long as you get them in within 180 days of realizing the gain. Which is important to note, because if you have $1 million in trading gains and 900,000 in losses, you could make $1 million investment into an opportunity zone fund and roll forward the $900,000 loss for future use. Very valuable tax strategy. I'm not your CPA, get your own advice, but you just play one on TV. And then last but not least, If you have a concentrated stock position, or your clients do, this is a great strategy for them to say, hey, you worked as an early stage employee at Uber or something, you got this concentrated stock position. As long as the sale of that position produces a capital gain, then they can diversify the risk, in my opinion, between you're still working there, that's where all your income comes from, that's where all your net worth is. Maybe it's time to take a piece of that and put it into income producing real estate instead of everything into that one particular company. So hopefully that was all helpful to you. It's 11:01 and I don't want to finish late. I'm sure you guys all have very busy days, but feel free to reach out to me directly or vis-a-vis the invest@caliberco.com. I do see that as well. And I appreciate all the time.
Thank you, Chris. This has been great. Thanks everybody for the wonderful questions. We appreciate you coming up here and educating our audience about opportunity zones. So like Chris said, if you have any questions or want to get in touch with them, it's invest@caliberco.com. You can email me, jeremy@flya.org if you have questions as well, and I'll pass them along. You can go to the website. There's a way to reach them as well. But thank you again, and we will let everyone go at this point.
Yeah, make it a great day, guys. Thank you.
All righty.